Welcome to another episode of A Quest for Twice. Today is February 28th. Current earnings season is wrapping up. Today I'm going to cover earnings from two of my favorite companies. The first one is Walker Dunlop. As I mentioned before, it has two segments. The first one is capital market. Its revenue is driven by transaction volume. So if we look at the chart on the top right, we can see the orange bars on the transaction volume in that quarter. The fourth quarter transaction volume was another decline from the peak 1 year ago. As a result, its revenue also declined from the peak 1 year ago. Now the transaction volume and the quarterly revenue from that segment is roughly in line with the first quarter of 2021. However, if we look at the EBITDA, the fourth quarter EBITDA was a little over $5 million. That's better than break-even in the third quarter EBITDA. However, comparing to first quarter 2021, it's significantly less, a reduction by about $10 million. The reason is significant expansion and personnel expense related to its segment business. For example, its personnel expense in the fourth quarter is greater than the revenue excluding MSR. However, not all personnel expense is a cash expense. That's why despite the personnel expense is greater than revenue minus MSR, its fourth quarter EBITDA is still over $5 million. So for the whole year, its EBITDA was $36 million compared to almost $85 million in 2021. As I mentioned before, this is due to the very fast rise in interest rate, causing the buyers go on strike, reducing the transaction volume. If rate stabilizes, then the buyers should return, then the transaction volume should rebound. But we'll see. The good thing is Walker Dunlop has another segment called Service and Asset Management, SAM. Its revenue is much more stable. So its EBITDA and EBITDA margins. So we can see in the past quarter, its revenue actually is at a historical high level because of the acquisitions of Alliant and Zelman in fourth quarter 2021. It's also helped by the interest income from its escrow account. Because of the rising interest rate, then the interest income is also rising, as shown in the chart on the top right. So for the full year 2023, the interest income is expected to exceed its corporate interest expense by $60 to $80 million. Looks like it had a dip in first quarter 2022. Other than that, its quarterly EBITDA is usually over $100 million. So I believe its run rate annual EBITDA will be exceeding $410 million. Its corporate is EBITDA drain about minus $130 million. So even if its capital market is breaking even in terms of EBITDA, its company-wide EBITDA will be over $280 million. As a matter of fact, in 2022, Walker Dunlop's EBITDA was $325 million. So in terms of cash outlay in the last 3 years, $64 million was spent for buyback, $84 million for forward dividend payment, $32 million for interest payment in 2022, and over $80 million for income tax. So its EV over EBITDA is about 11 if its share price is $88, and PE is 15.7. The management gave a guidance for 2023 EBITDA of double-digit growth because 2022 EBITDA was suppressed by the poor performance in its capital market segment. So once that rebounds, the EBITDA will grow fast. So the double-digit EBITDA growth is very credible. And even with the 2022 EBITDA as a denominator, the EV over EBITDA is attractive. As a result, my conclusion is Walker Dunlop's share price is significantly undervalued at this point. Mercado Libre also reported excellent fourth quarter. In that quarter, there were unique MELI users about 96.6 million. That's up 18%. Its e-commerce segment revenue was 55.4% of total revenue, a reduction from previous quarters. Not because that segment is doing poorly. It's actually because fintech segment is performing extremely strong. For example, in the last quarter, 72% of total payment volume was off a platform. That basically means Mercado Libre is being used by regular citizens just outside the online world in the real world. So that's a very strong sign of strong adoption of Mercado Libre's financial products in day-to-day world. Its unique fintech users increased to 43.7 million. That was a 27% increase year on year. So let's take a step back. Look at its annual revenue in the last 9 years. So we can see a significant revenue increase in 2020 compared to 2019. Then another big jump in 2021. One could argue those 2 years were strongly benefited by the pandemic, which was true. However, if we look at the 2022 revenue, it's another significant jump up from 2021. So despite the reopening in the real world, Mercado Libre's business wasn't really significantly impacted. If we look more closely at the commerce segment revenue, we could see the commerce segment revenue's rate of increase was less in 2022 compared to 2021 and 2020. However, its fintech segment revenue really took off with or without the pandemic. It's even more impressive to see its gross margin in 2022 actually increased compared to 2021 and 2020. That's because of the lower first-party sales mix in its commerce segment and better usage of its logistic network. So that's operational leverage. Now let's look at its quarterly revenue performance in the last 2 years. So we can see the commerce service revenue has been increasing each quarter. Despite usually commerce companies benefit from Christmas shopping in the fourth quarter, then it would suffer a drop-off in terms of revenue in the first quarter. That's a sign of more and more vendors are using Mercado Libre's platform. So we don't really see a significant drop-off in the first quarter of 2022 from fourth quarter 2021. We do see the commerce product sales drop off from fourth quarter 21 to first quarter 22. That's because of the seasonal effect, as I mentioned. Another interesting observation is about its fintech revenue. So there are two segments. One is credit revenue. That's the brown line, and the the other fintech service revenue, that's the green line. So we can see a fast increase in credit revenue from first quarter 21 to second quarter 22. Then it really is decelerated. That's because of the management was aware of the macroeconomy risk and decided to slow down its credit book growth and focusing on the credit quality. On the other hand, we don't really see any slowdown in terms of fintech services. So its fintech segment revenue was $1.3 billion last quarter. That's driven by its fast growing total payment volume. So in the fourth quarter, $24.5 billion were payments related to business, and 11.5 billion was related to individual accounts. In the last quarter, the credit revenue was 42% of total fintech revenue, and that's driven by very fast credit growth. So at the end of last quarter, the total credit book was $2.84 billion, compared to $1.7 billion 1 year ago. However, as I mentioned earlier, that growth actually slowed in last 2 quarters. So from Q2 to Q3, that was only about $100 million of credit book growth. And from Q3 to Q4, that's about $70 million of credit book growth. So the management was focusing on credit quality instead of growing its credit book in the last 2 quarters because of the rising default risk. So we can actually look at that impact on business. That's measured by the interest margin after losses. The acronym is EMO. In the fourth quarter, the credit revenue was $560 million. Credit loss was $216. So EMO was 344. The EMO spread was 48.3%. That's a significant increase from 37.1% in the Q3 22. And this EMO spread had bottomed out in the first quarter 22 at 24.7%. So the takeaway is management probably saw its deteriorating EMO margin and decided to slow down credit book growth and focus on profitability, and that pays off in terms of the historically high EMO of $344 million in fourth quarter and a very high margin of 48.3%. So I have to give credit to the management for managing its credit business prudently. So I can reaffirm my previous investment thesis. At $1,140 per share, its price over sales is about 5.5. That's very reasonably priced. The duration to parity is less than 4 years with 54% CAGR. And it has a wide moat from network effect and high switching cost. That's reflected by its return on invested capital reached over 20% in last year. That's a historical high. And there is no falling back from 2021 and 2020. Those 2 years were helped by pandemic, but 2022, for many pandemic beneficiaries, their business performance suffered from reopening. But Mercado Libre's business actually accelerated. And compared to 1 year ago, its commerce take rate and fintech take rate were both higher. Again, a strong indication of its business health. This concludes the latest episode of Quest for Twice. Until next time, happy investing.